Hello, this is the Unemployed Value Degen. I'm not giving financial advice, and thank you for joining me today. We ended the week in the green for the first time in a month since the February 29th high and this 10% drawdown. We had one of the fastest market corrections, one of the fastest 10% drawdowns on record, and I think the next question is, well, is this a bounce? Is this a bull trap? Are we still going to continue drawing down, or are we going to be back to the races? Are we going to have a V-shaped recovery, or are we going to climb out of this slowly, or are we going to keep on crashing lower? Now, I think I mentioned last week, 10% corrections are pretty common in a bull market. A 20% correction without a recession would be very uncommon. I'll go back to the 5-year. Right, so we had a bear market when the Federal Reserve was raising interest rates, but after that, when we were, this recent bull market on the AI revolution, having a 10% drawdown once a year, even crossing below the 200-day moving average for a bit, that's common, that's normal. Having a 20% drawdown, having a full bear market in the middle of a, without some sort of a recession happening, that would be very rare. But back on the speed of this drawdown, this is the 5th fastest in the post-World War II era. And the other 5 or 6 that were as fast or faster, right? So the fastest one was COVID. That happened in 2020. In 2018, on Trump's first trade war, we also had a 10% correction that took place. So this was 20 trading days. On Trump's first trade war in 2018, there was a 10% correction in 13 trading days. In 1955, Eisenhower had a heart attack. In 1950, it was the Korean War. In 1979, Paul Volcker, raised interest rates and shocked the market. And in 1997, we had the Southeast Asian financial crisis. So what's happened in the last 20 trading days, this Trump 2.0 trade war, to me it looks like just a big uncertainty spike. And uncertainty causes multiples to contract. Now, unless there's going to be, so in COVID, right, there was uncertainty because of COVID, and then it turned out to be, a real economic harm, mostly from the lockdowns. But in the other cases, the situations resolved themselves. It didn't lead to any further drawdowns. So once the uncertainty is gone, once we have some sort of a resolution on Trump's trade war negotiations, well, when that uncertainty is removed, the market can go back to higher multiples, unless the trade war really devolves into retaliatory tariffs. And but I don't think anybody thinks that's super likely. For one thing, the stock markets of Canada and Mexico are doing just fine. If people genuinely believed that these tariffs would stay for a long period of time, their economies are much, much more tied to U.S. trade than the U.S.'s economies are tied to their trade. And the Canadian stock market is doing okay. The Mexican stock market is doing okay. Neither stock market is pricing in a protracted trade war with the U.S. I think most market participants think that at some point Trump's going to, achieve some sort of resolution to these tariff negotiations. Aside from that, once the uncertainty is removed, I think we're back off to the races again. In each of the previous cases, so if you look 1 year after the 5 or 6 previous times the S&P 500 fell 10% in 20 trading days or fewer, the market was higher 6 out of 6 times a year later. It was higher 6 out of 6 times 3 months later. But a year later, it was about 20% higher. So just the average case would be that 1 year from now, by the time we get to March 2026, we'd be up 20% from here. And that's the average case from a drawdown this fast. because the speed of the drawdown, I think, tells a lot. That this was just the sudden spike of uncertainty, which crushed the multiples in the market. And those multiples can come back when that uncertainty is removed. And at some point, you know, whether you're for Trump or against him, at some point, Trump's first 100 days is going to be over. He's going to run out of a lot of inertia. He might not have a cooperative Congress or a Senate. And what he's able to get done is going to slow down an awful lot. And there's going to be a lot more clarity on what the world is going to look like. And that kind of clarity is, I think, going to be good for market multiples. So we'll see. I mean, the market could keep selling off. It's possible. I just don't think it's super likely. Again, if this is still fundamentally a bull market, and we have, you know, a global interest rate cutting cycle, we have the, you know, artificial intelligence revolution, the data center build out, we have Europe and China both stimulating, and, you know, we have uncertainty in the US, but again, I think a lot of that uncertainty is going to be removed. So I don't think the market has to fall farther. I don't know if it's going to be a V-shaped recovery, or if it's just going to slowly climb its way out of this. But we're still below the 200-day moving average. So let's go ahead and look at, and also one other factoid. This is the first time ever that the S&P 500 fell 10%. The first time we've had a correction, and the VIX didn't get over 30. So the volatility index, what people are willing to pay for options, it didn't spike above 30 during this entire drawdown, which is pretty amazing. So that's a very orderly sell-off. Nothing really went frantic or lost control. It was fast, but it was orderly, which is just a bizarre set of circumstances. It's just the realization that Trump 2.0 is different from Trump 1.0. I really think that's all that happened. That compressed multiples from, you know, the S&P 500 from about, what was it, a price to earnings of 24 to 22, or from 22 to 20. And then when that uncertainty is relieved, and the S&P 500 will get another couple turns of PE ratio back on it again, and we'll have this 10% drawdown behind us. In the meantime, back to the global cutting cycle, you know, interest rates are off their peak. Interest rates are off their peak and quite possibly declining. And Scott Bessent did an interview recently where he discussed what his plans were to achieve his goals. And let's see, what's the right slope of this thing? Something like that. He did talk about how important it was to get interest rates lower, that every basis point was $1 billion a year in interest payments, and that was a major priority, but also that he targeted specifically some regulations on small and medium banks that the Treasury could remove single-handedly without an act of Congress. So this is something within Scott Bessent's ability to control. And he thinks that that could be responsible for between 30 and 70 basis points. And between 30 and 70 basis points would get us from 4.25 to, what is that, 3.9? Is that 3.95? Sorry, I thought I had a line here. 3.95. Okay, well this is not drawing the way I want it to, but oh no, there is a line there. From 3.9 to, so 70 basis points would bring it down to 3.55, yeah, about there. So again, in a recent interview, Scott Bessent said that there was a regulation on what they charge small and medium banks to buy treasuries, that if that was removed, he think would be responsible for lowering interest rates on the 10-year Treasury by between 30 and 70 basis points. Well, that would put the 10-year Treasury in this band from here. And that would be a very stimulative Treasury rate. Now, it would be an inverted yield curve if the Federal Reserve didn't cut. I think it would take about 3 cuts to get to match that, maybe 2 or 3. But without that, if you have somewhere around a 3.5% 10-year Treasury. Well, that 3.5% 10-year Treasury would correlate to about a 5.5% 30-year mortgage. And I think that's the number that it would take to thaw out the housing market and also to get people to take out home equity loans. And those home equity loans, Americans are sitting on so much home equity from the house price appreciation that took place during COVID. And there's a lot of people out there that I think would take, you know, $50,000 or $100,000 out of their home equity, and they'd, you know, go on a trip or buy a Winnebago or buy a couple of jet skis or a boat, whatever it is, because 40-year-olds don't really need to own $300,000 of home equity. They could enjoy their life a little more while they're younger. So if Scott Besson is right, if this is where the 10-year Treasury is going to be, on a regulatory change that's completely within his power to do, then I think we're in this, you know, declining interest rate environment, and I think that's going to be highly stimulative. You know, I think that's going to be off to the races. Back to the dollar index. So the dollar weakened quite a bit off of its peak in January. It didn't fall the previous levels, and I don't know which direction it's going to go from here. I saw that on the last opportunity, it was either the UK or the EU or both, but they didn't cut interest rates this time. I think they paused. So the EU is about 1.5 percentage points lower than us. They didn't want to keep on going even lower. At some point, those interest rate differentials really wreak havoc on currency exchanges. And with Germany announcing 1.7 trillion euros of new debt and stimulus and defense spending, they even put 100 billion euros of new green energy spending, because the new coalition, the Green Party, was invited to join the new governing coalition, and the AFD, the Alternative for Deutschland, was not. So the Greens are able to get another 100 billion euros of windmills and things like that. Crazy. But the interest rates on German debt, it's getting back to levels that we saw in the PIGS crisis, where Portugal, Ireland, Italy, Greece, and Spain had their treasury rates just blow out. And so now Europe's in that situation where their interest rates on their longer term debt is rising. So we'll have to see the consequences of that. And if that's going to correlate to a stronger dollar, there's a lot of talking heads that say, oh, you know, Trump is making the U.S. less investable. Foreign money wants to flee Trump. I'm not so convinced that's true. The overall narrative is Trump wants a weaker dollar to stimulate exports. But with the United States having cheap electricity and relatively higher interest rates, that's a lot of tailwinds for the dollar. Right? That could really end up with a much stronger dollar than. There's some fund managers out there that think, you know, we're heading toward, during the Trump term, something like a dollar index that's pretty far down here in the it may be as low as 90 or lower. That's a long way down. That's an awful lot of weakening for the dollar to do. And I don't know if we can accomplish that while our electricity is still, it's more expensive than China by a good bit, but it's cheaper than most of the rest of the world. So if we still maintain having some, relatively cheap electricity, and we have relatively higher interest rates than most of the developed world, I think it's hard for the dollar to weaken that much. So when we were about here, I was really talking on my Substack a lot about Brazil, Colombia, PagSeguro, Nubank, Bancolombia, El Cresud, a lot of South American stocks. And as the dollar was strengthening, those trades did not work, but they've done a lot better with the dollar weakening. It's less obvious to me now where the dollar goes from here, but I still like my South American picks. And if I had any disposable income, I would be adding to them. But this recent drawdown has left me pretty stretched. the fear and greed index. We've been in extreme fear this entire time. Right, we've been in extreme fear since the February 25th, and we haven't left it yet. We're still in extreme fear, which is pretty amazing to me. What I like to look at the most is the put-call ratio. Actually, I don't even like the put-call ratio as much as I like just pure put volume, which reached a new record. But Friday was triple witching day. So Friday was the option expiration for the weekly, the monthly, and the quarterly options. And it's not obvious how much of the puts that people bought, how many of those were 0 days to expiration, how many of those were for 1 week, 1 month. It's not clear to me how many puts are outstanding. And then here's the VIX coming way back down. The VIX is under 20. And again, on this drawdown, the first time we had a 10% correction, and the VIX didn't crack above 30, which is pretty amazing. So the volatility index is declining. Put-call ratio is still elevated. There's still a lot of people out there that are buying puts. And the yield spreads haven't even come close to blowing out, right? It's still a very narrow spread between investment-grade bonds and junk bonds. And you almost always see this spread blow out before any serious recession. The people that analyze bonds individually, they spot which company is going to be unable to repay their debt long before the market really understands that we're in a recession. And there's still nothing like that coming. And then the style box, where for the last 3 months there's been this safe haven demand for large value, and almost everything else has been in the red. But small value has, this is the the not fun kind of outperformance where you still fall, you just don't fall as much as some of the other things. So that's it's still outperformance, but it's not fun outperformance. And still here on the 1 month, right? So value is only down 4.5 instead of 8.5, comparing small value with large growth. But this isn't the sort of outperformance that's very comforting. All right, and back to the S&P 500. Let's look at some of the major indices. So the S&P 500 had this 10% drawdown in 20 days. We've had 1 week of bouncing. It's not obvious if this is a bull trap, a dead cat bounce, whatever you want to call it. I think the worst is behind us. But if we break that down into looking at the Mag 7, right? So the Mag 7, that sell-off was not from an all-time high. So the S&P 500, that 10% correction was from an all-time high. The Magnificent 7 weren't. The Magnificent 7 were in a bit of a decline before the sell-off. Let's see, I think that was the NASDAQ was at an all-time high, the S&P 500 was an all-time high, but the Magnificent 7 wasn't. And out of the Magnificent 7, Nvidia has a death cross. Nvidia has the 50-day moving average falling below the 200-day moving average. And for technical analysts, that's a big deal. So this is kind of a make or break time, where either Nvidia starts bouncing pretty hard from here, or it breaks down pretty hard from here. I still think the artificial intelligence revolution is in its early days, but I am way less confident that Nvidia itself, has aggressive growth in front of it. It has still price to earnings ratio of 40 is aggressive, but it's not aggressive compared to the growth that it's still delivering. But I have a really hard time estimating how much growth it'll still deliver. Yeah, I don't have a position in Nvidia, but I think that death cross is pretty important. The other thing that has a death cross is the Russell 2000. Maybe it's not, hasn't quite crossed yet, but it's a death kiss. So the 50-day moving average has just moved here to touch the 200-day moving average, and the Russell 2000 is way below the 200-day moving average. And our peak was in November, so this has been a very painful time to be in small caps from November all the way down. I think the full drawdown, it wasn't quite 20%, it was like 19.8% or something like that. But if you look back for 5 years in the Russell 2000, it's not like we're falling from some great height, right? We're pretty much at this level, right? Maybe that was past resistance. You know, I was super stoked earlier in the year when this past resistance line became support. But now we've broken way down below that. I think, you know, in a very unjustified fashion. The argument for small caps is supposed to be, well, small caps, a lot more of them are US only, so tariffs aren't going to bother them. And with interest rates falling, the big threat to small caps is their debt burden and their interest expense. So with falling interest rates and more tariff insulation, you'd think that small caps would be doing better. But no, they've had an aggressive sell-off, and it's brought them to a place where, you know, it's below that, that resistance level. You're pretty much flat for 4 years in the Russell 2000. Now that's painful. The Russell 2000 has some composition problems, it has a lot of biotech, it has some profitless tech, it has some fallen angels. Any stock that really performs well graduates out of the Russell 2000 and joins the mid-cap index. So that's one of the problems of the Russell 2000, is you lose all the good components out of it. But this is still a very painful time. And that death cross, which I don't anticipate the Russell 2000, you know, climbing above this in the middle of next week to prevent that. So it looks like the death cross is going to happen. And I don't know how the, you know, sometimes technicals work better on individual stocks than on indices. I don't know, but with ETFs, people can short the entire Russell 2000 pretty easily. So, and also the Russell 2000, the total market cap, is a heck of a lot smaller than a lot of individual stocks in the S&P 500. Let's go to some individual names. Let's see. There was one, doing this out of order a little bit. ARS Pharmaceuticals had a pretty amazing chart. Let me break this down a little shorter. Now, I don't know enough about technicals to be as bullish on this, but some of the people that I was reading about discussing the situation said this is a very bullish pattern to them. But ARS Pharmaceuticals released earnings. The earnings were fantastic because they were net income positive. You know, so ARS Pharmaceuticals is doing this epinephrine nasal spray to replace EpiPen. And I think it's pretty clear that they're going to replace EpiPen. It's just people do not feel comfortable using needles, and the nasal spray is just a much better use. It also has twice the shelf life, and same price. There's no cost savings, but you have twice the shelf life. And on the quarter where they announced net income positive, you know, they jumped from 1150. It touched 15 during the day. What's so amazing is the next day it fell back. And I think what the bulls see about this is, for one, it's, you know, resting on the 200-day moving average. Back to the 1 year. And this is not my technical analysis, but what they were saying is that this was a very strong point of resistance, and that the odds of it breaking out and bouncing from here were very good. I don't know about that. I have a hard time looking at this chart and being convinced either way, but fundamentally the last earnings call was so good. So, you know, I've been talking about this every few weeks as far as, and at $12 it's still an attractive entry price. I'm going to have to go through, and the market cap now is about 1.2 billion. I'm going to have to, I haven't put a final price target on. I don't know where it's going to end up, and it's a little tough because the total size of the market. So a lot of the growth companies focus on TAM, total addressable market. And what's interesting about the epinephrine is there's a lot of people with serious allergies, but there's an awful lot of people that are prescribed EpiPens and don't get the prescription filled. And now the management team of ARS Pharmaceuticals said that's because they're afraid of needles. I don't know how true that is, but there's going to be a growth in the market. If you don't have needles anymore, there's going to be a lot of people who will buy this, especially if insurance pays for it. So if your insurance pays for it, it doesn't cost you anything. People who were afraid of needles will now start getting the nasal spray. So I think the analysts are calling the total addressable market of EpiPen something like $4.4 billion. But the percentage of people that are prescribed it and don't get it is, in the US it's about half, give or take. I'd have to double check the numbers, but half of the people that are prescribed an EpiPen just don't get one, whether they have insurance or not, because they just don't want to deal with needles that need to be refrigerated. And I understand that. If it was my kid with severe allergies, I would get one. But yeah, so putting a final price target without really knowing how big the market is going to be, I think the easy prediction is that they're going to replace EpiPen. The much harder prediction is how much can the market grow. There is a competitor doing mouth strips, that's AQST, even if you just think of this nasal spray taking 50% market share, it would be pretty impressive. But they were competitors also with Narcan, the drug for opioid overdoses. And with the nasal spray compared to the mouth strip took about 95% market share. And I think the reason for that is if somebody's overdosed on drugs, they're not cooperative. You don't want to have to pry their mouth open and shove something on their tongue. But with the anaphylactic shock, one of the side effects is vomiting. So if you have a chance where people are going to be vomiting while they're in anaphylactic shock, you don't want to be in a situation where you put the mouth strip in and then you don't know, did it get dissolved, did the medicine get absorbed, or did it not, or they just threw up. I think the nasal spray is just going to be a much more effective delivery mechanism. I think that's going to be what doctors end up prescribing. And the mouth strip is still a year away from getting FDA approval. So you've got a whole year to take the market while your competitors are still trying to get ready. So I don't have a good prediction on what the full market cap is going to be. I have a hard time seeing if this chart is as bullish. A lot of people on Twitter that were better at technicals than I was were saying this is an amazing setup. I don't know, but I think fundamentally it's fantastic. I was honestly shocked to see a pattern like this. This was surprised me to have just an enormous gap up in a day, and for it to give it all back the day after was a pretty big surprise. The setup on Centrus Energy is looking pretty good. It's been hovering in this $75 range, consolidating and looking like it needs the possibility to break out. I don't know what, Centrus Energy, one of the things hanging over the stock is they have a lot of contracts that deliver enriched uranium, but they were importing from Russia. And while Trump is in the middle of these negotiations to end the Ukraine war, I don't know if we're going to see that they're going to be able to fulfill their, I think it's 2027 and 2028 deliveries with enriched Russian uranium, because the United States imposed an import ban, but then offered waivers. And Centrus Energy got waivers for 2025 and 2026. And then Russia started matching our import ban with an export ban. So now you need a waiver from the United States to import and a waiver from Russia to export. And it's always a question of whether you'll get both waivers or not. But with an end to the Ukraine war, there's a chance that that situation becomes a lot less tense. And then there's the 3 Department of Energy contracts that Centrus Energy won. And they're 10-year contracts where the money is pay as you go, paid over time through work. And we don't know how much of that $3 billion Centrus Energy is going to win through that system. But technically, I think the setup looks pretty good here. This has been a level where it's been consolidating for, for a little while. Or if that number is down here, I don't know if it's going to see 65 again. But I think this is a pretty attractive place to buy. Usually when it's in the 90s, right? When it's here at 90, I say, well, at least it's not 120. When it's down here at 75, it's a lot more attractive. I could add to it there. The number one stock that I want to add to right now, though, is Douglas Elliman. Now, all the moving averages are getting squeezed together, and that's usually what you see before there's some explosive movement one way or another, up or down. Douglas Elliman, so for one thing, they're a realtor, and they're a realtor in the luxury market. They're a realtor focused on the high end. And this high-end realty, for one thing, you have the LA fires that burned down an enormous number of very, very wealthy homes. And a lot of people, rather than rebuild, are going to sell the land and move somewhere else. I think you're going to see a pretty significant number of purchases in the high-end trophy properties because of the LA fires. On top of that, you have falling interest rates. On top of that, you have the stock market and mergers and acquisitions picking up. So one of the things that leads someone to buy a $20 million house is because their company just got acquired. So the stock market is relatively high, mergers and acquisitions are happening. And then, I think I'll write about this maybe for Monday on my Substack. I finally got into the details of the Trump gold residency permit that he's selling for $5 million each. And what I didn't understand about it is, so if you're a non-US citizen, you buy one of these cards for $5 million each, it gives you the right to come and go as you please in the United States, but you're not a citizen. And the thing about being a US citizen is the United States is one of the few countries that taxes your global income. So if you're a US citizen and then you become a resident of Argentina and you live and work in Argentina, the United States is going to demand you pay them income tax on the money you earned in Argentina. And Argentina is going to want their income tax as well. You get a credit, you get a tax credit for foreign taxes paid, but you're still probably going to have a US tax bill. These gold non-resident cards, or these gold resident cards, non-citizen but resident, that people can buy for $5 million, you'll have to pay US income tax on your US income, but you don't have to pay US income tax on your global income. So these $5 million gold resident cards, it kind of creates like a super class of people that have, more freedom of movement and maybe more rights and privileges than US citizens do. And I think that's a very, very attractive thing, to be able to come and go as you please in the United States, but not have to pay income tax on your global income. And Commerce Secretary Lutnick said he's already sold 1,000 of them, which is, it's a beginning, but that's since it's been open for a week. And if there's a chance he could sell, okay, suppose he sells 20,000 of these gold cards. Suppose, all the sheikhs and all the princes and all of the tycoons and anybody who's worth, several $100 million drops $5 million, and now they have US residency and they can come and go as they please. Well, what are they going to do next? Are they going to buy a $20 million condo in Miami? And if they do, is Douglas Elliman going to get the commission for that? So, 1,000 people buying these cards sounds like a small number, but you're talking about high-end real estate. An extra 1,000 transactions a quarter for $5 or $10 million luxury condos that's going to move the needle on this company's revenue. So not only do you have the effect of the LA fires and interest rates coming down, but this gold immigration, gold residency card that they're selling for $5 million a piece, you could get 10, 20, 30, 50,000, multimillionaires from around the world buy these cards for them and their family members, and then come to the United States and buy a condo. Any oligarch, any prince, any sheik, any tycoon who doesn't have U.S. residency already, I think it's an attractive program. So you have these moving averages converging. Douglas Elliman is getting ready for an explosive move one way or another. You have a new CEO, and he looks like he wants to expand the scope of Douglas Elliman through acquisitions, which he's done before in other companies. The old CEO focused on new build condos, and the new build condos, that revenue comes in, it gets recognized 4 or 5 years later. So the new build condos that they sold during COVID, well, that revenue is all coming in now. There's just a lot of good things that are going to happen to Douglas Elliman with falling interest rates. And So yeah, in the start of the year, I had listed 2 stocks that I wanted to put my marginal dollar towards. The first was Monument Mining, and I did, and then after their last earnings call, I think it's up 30% this year, something like that. Let me see, what is Monument Mining up this year? I have to look back in a different spreadsheet. Anyway, I think this is, nope, it's not only US based. So yeah, so I think it was down here in the 28-cent range. That before their last earnings call, all I wanted to buy was Monument Mining, and I did, and it's climbing. And as the price of gold goes up, I think this is still going to be climbing aggressively. I'm glad I own it. I'm not buying any more at this price because I don't want to become over-concentrated in a single junior miner. And then the other stock that I had mentioned wanted to buy more of in the start of the year is Burford Capital. Now, Burford Capital, I might change my position. I might buy Douglas Elliman before I buy more Burford Capital. Last year, I said that I had a suspicion that this case will get resolved in the fall. There's one final appeals process happening that Argentina is fighting, and I think that appeals process will get resolved in the fall. I'm not as confident as I used to be that Argentina is genuinely interested in settling this liability quickly. It looks like Argentina is going to be able to use international debt markets even before this case settles. And if they can, if they can successfully raise debt at an attractive interest rate without settling this case, then why would they settle this case? So I'm a little bit less sure that Burford Capital is going to have this huge rally in the late summer of 2025. And instead, what I want to be buying aggressively right now is I think I want to buy all the Douglas Elliman I can get my hands on. So I think that's where I'm going to be putting the marginal dollar for the next, for the next few weeks at least. Let's see. It's been an amazing time in the market though. And a New Fortress Energy. I mean, the price was pushed intraday down to like $7.50 a share, and it's bounced very hard off the lows. And during this entire time, there was almost no fundamental news happening, right? This was just purely a technical momentum-driven event, and now it's back on the upswing again. I had some of my subscribers writing comments on the article I wrote about them, saying, "Well, it looks like they're headed toward bankruptcy." I said, "Well, what are you basing that on?" Well, the stock price, it's priced for bankruptcy. It's just one of those situations where price drives a narrative. And now that it's out of the $8 range and back up to the $11 range, suddenly it's exciting again. I'm pretty full on New Fortress Energy. I won't be buying any more, but it's been quite a ride down from $16 to $8, and then back up to $11. And during this entire time, it's still with a 50-day average below the 200-day average, because this was quite a drawdown. This thing has been drawing down for a while, at least since, what was the last peak? 2022. But New Fortress Energy, they have a lot of positive developments. There's a big potential catalyst coming. There were some rumors floating around online. So New Fortress Energy announced that they want to sell their Jamaica business. And somebody had posted online that the investment bank they work for had an earnings call, or it had a call with management, and they had the notes from that call and what the status is, that there were four interested parties in Jamaica that had done site visits, and one that the negotiations are pretty far along, and that we're very likely going to hear closing the Jamaica sale within a couple of weeks. And they also gave the prices that they think it's going to close at. And the numbers they gave were pretty close to my estimates and my analysis. So it's not usually smart to listen to rumors, but this one, the numbers they gave seem pretty accurate. So you might get a positive catalyst with some debt retirement from the Jamaica sale. And there's also, so they're renegotiating their contract with Puerto Rico. And I think they shortened the contract so that they could get a new contract. So they voluntarily gave up a year. I think they only have a month left. So there should be some news about a new Puerto Rico contract. You'd think that would come out within a month, right? They're not going to let that contract lapse and have no natural gas deliveries. So a new Puerto Rico contract that hopefully involves a much longer time frame and possibly some natural gas conversions, plus the sale of the Jamaica assets. Those are really big catalysts for that stock. And that's all within, potentially within 2 to 4 weeks. For New Fortress Energy. So that's exciting, even though it was so painful for it to be a large part of my portfolio. This is my 4th largest position, and it just went from 16 to 7.5. That was very painful. Finance of America companies had they had that earnings call, and it moved around a lot intraday. But it's still staying flat in this consolidation period, right? It's still consolidating. I don't know if it's going to have an aggressive move one way or the other before the next earnings call. But the yield curve has flattened a lot. And the critical thing for Finance of America company isn't the level of interest rates, it's the yield curve. And the flatter the yield curve, or the more inverted the yield curve, the higher the spread they capture. And the yield curve, if Scott Besson is right, it'll become inverted again if Jerome Powell is behind on cutting. But otherwise, it's a very, very flat yield curve, and that should be good for them. So I'm still very bullish Finance of America company. I had feared the worst, that on last earnings, the stock price could have, the market could have interpreted it poorly. Initially, I think the algorithms did, but real thinking human beings came in and brought the price back up. I think the big catalysts are going to come next quarter. Just the mark-to-market effects should be much more positive. But the quarter after that, the first real cash from mortgage-backed securities being called in and having residuals should be arriving. And we'll hopefully learn what management does with that cash when they have it. And hopefully they retire some of that convertible debt, which is as good as a share buyback. Plus they don't have as much interest expense. Let's see. Medical Properties Trust. I thought the short squeeze would be more aggressive. It's holding and consolidating right around this, $5.90 to $6 range. But maybe the short squeeze isn't going to come until they announce a new higher dividend rate. But there's, for 2 years, they're in a position where all news was bad. I think now they're in a position where all news is good. So one of their tenants, Prospect, just announced, and Medical Properties Trust has, I think, $150 million mortgage on their properties in Delaware. They just announced that they finally came to an agreement with the government of Delaware that they're going to take over those hospitals from them. So that's going to be, and during the bankruptcy process, Medical Properties Trust had written off that $150 million. So Medical Properties Trust took a $150 million hit to book value, saying that asset was worth $0, and now it looks like they're going to get paid. So a quarter where they have, positive, it's the opposite of write-downs. What do you call the opposite of write-downs? Are they write-ups? But where they can increase book value by $150 million. Things like that could cause a short squeeze, because the short interest on this thing is still enormous. I think it's like 37%. It's a crazy short interest, but I was surprised that the short squeeze wasn't more aggressive yet, but I'm happy it's consolidating at a much higher range than it's consolidated at for a long time, right? Because you had peaks here, but you didn't have periods of real consolidation here in the $6 range. Let's see. There's a Sibanye Stillwater has been for the first time in a while, trading with a 4 handle, and it looks like it's been trying to break out. It's been holding for a whole week above the 200-day moving average, and this stock for a couple of years now, it hasn't spent a lot of time above the 200-day moving average. Yeah, so you can count on just one hand maybe the number of times that it spent more than a week above the 200-day moving average. And I think the bottom could really be in for Sibanye Stillwater. I mentioned this on the last video that the price of rhodium had finally started moving. Ruthenium also, so that's one of the smaller platinum group metals, is finally starting to move. But also they own half of DRD Gold, and they produce 600,000 or 700,000 ounces of gold themselves. And gold's at $3,000 an ounce and holding pretty steady there. So I think the worst is over for Sibanye Stillwater. It has been a very long and painful process. But when the cycle turns, I'll be looking forward to riding it all the way up. I have to see how diamond my hands are, if I can hold on to this thing without cutting my position too much. The expression is don't cut the flowers and water the weeds. Let your winners run. And once this thing is rallying, I don't think anything will stop it. Let's see. So it was previously here at the $18 range, $16 to $18. I think Sibanye Stillwater, and they have done a lot of acquisitions since then. It's a much bigger company with a lot more assets. And I don't think they've done any dilution. I'd have to double check that. But I think this will, on the next platinum metals bull market, I think it's not going to stop until it hits $25. So I need to see if my hands are really that diamond. But I think the worst might be over. Trying not to jinx it, being very cautious, but it doesn't spend a lot of time above its 200-day moving average, and that here we are. And some of the platinum group metals are starting to move again. Abacus Life hasn't announced earnings. They announced earnings on March 27th, and it's a very, very flat consolidation pattern here. So I don't think anything's going to happen, at least till earnings. And when the earnings announcement does happen, it's more based on the earnings. It's more gambling. But I have a call with management to talk to the CEO on March 31st. So if you have any questions for the CEO of Abacus Life, you can go ahead and put that in the comments. I'm definitely looking forward to that. I'll do a paywall right up on the Substack with what I'm able to get out of him. But this is part of my silver tsunami trade along with Jackson Financial. So Finance of America companies, Abacus Life, and Jackson Financial. Those are my 3 silver tsunami stocks. Jackson Financial, shocked that it sold off so hard from the $95 range, but here it is. That could be coming to its own. If it doesn't get above the 200-day moving average soon, it'll be converging to its own death cross here. I don't think it deserves it, and I did a video where I did a price target on it. It's trading at a price to earnings ratio of about 4.5, which is just absurd for a company that has such a high quality factor. I mean, they profit off of their assets under management, and their assets under management is very unlikely to surrender those contracts. So this is going to have very, very stable earnings, and it's trading at a PE of price to earnings of 4.5. But everything is getting crushed in this market. It's been a painful period since all small caps. And this has had its peak that last November when small caps started selling off. And I think Jackson Financial did get included in the S&P 600 small cap index. So it could just be index selling. It could just be people shorting the entire index. But I don't think this price deserves to be there. But at the same time, a death cross on the Russell 2000, a death cross here, people could push the price lower. It wouldn't surprise me. I still get a little surprised when good companies trade at such low prices, and because this is one of maybe the higher quality things I ever found, and the move from $110 a share down to $77 a share was pretty surprising for a company that's such high quality. It can really happen to anybody. Titan International. So Titan International's consolidating here about the $8.70 range. It seems like it keeps trying to maybe break out a little bit. At least it's holding above the 200-day moving average. It had the golden cross. This had a golden cross in the middle of February when this market was melting down. So this is one of those things that's been behaving very well despite the market meltdown. And it should. I mean, it had I don't think I mentioned this, maybe in the earnings update, but they did an acquisition which the market hated. Go back out to 2 years. So yeah, they did an acquisition which the market hated. But I looked at the acquisition, and the price to EBITDA was like 3 times, and it was also a stock-based acquisition. And then they've been doing an aggressive share repurchase plan. I don't think their long-term strategy is share repurchasing. I think they were trying to sterilize the acquisition. And so the price they paid for this acquisition, well, now that they're doing share buybacks after the price has been cut in half, they're essentially getting the acquisition for half off, right? Because they paid for the acquisition in stock, and then they're buying back the stock aggressively at half off, which is working out well for them. But the two companies merged, right? They each had a market-leading product for half the market, and the two companies combined got a global contract to be a supplier for John Deere. So it really was a better company with those two different product offerings combined to have a best in class across the entire spectrum for they manufacture tires, and they also do other things too, but it's not tires, it's tires, wheels, and the tank treads for those little bobcats, things like that. So anyway, the two companies combined are better than they were separate. They're paying for the acquisition at like a half off special, and the initial price wasn't even that expensive, and they just landed an enormous new contract because of it. So I think this is maybe one of my favorite little industrials, and I think we're headed toward an industrial boom. And this behavior at a time when you have the fastest correction in the S&P 500, fifth fastest in 80 years, and the stock price is staying above the 200-day moving average the whole time, I think this is showing a lot of strength. I'm really happy with Titan International. I wrote about Alta Equipment Group, and I'm going to put out a video doing a spreadsheet on their cash flow potential. The market really hates this thing, and for a good reason. Back in June or July, I think this might be the crash where they refinanced their debt. They refinanced, so this was a, go back out, that's probably not telling the most of the story, but this company is a roll-up, so it's a forklift and construction equipment dealership. They did an aggressive roll-up. They made 16 acquisitions. Now, one of the initial acquisitions was stock-based. Most of them were cash acquisitions. They paid about 4 to 5 times EBITDA for the companies they acquired. And in July of last year, they refinanced their debt out to 2029, but it was at 9%, which is pretty painful. But if you look at their cash flow, their free cash flow from before the acquisitions to after, even paying 9% on that debt, their cash flow per share doubled because of the acquisitions. I think I'm not 100% sure why the market hates it so aggressively. One of the reasons might be there's some accounting quirks. They have so dealerships for construction equipment and forklifts, you have and I heard about this also from Titan Machinery, not Titan International, but Titan Machinery, the farm equipment dealer. It's very common to have a rental business combined with a dealership because people want to try it before they buy it. So they might rent a combine harvester, they might rent some construction equipment for a couple of months, and then if they like it, they'll buy that one. They're not going to bring the old one back and then buy a new one. They'll buy the used one that they just rented. But that rent to sale model, the way the depreciation works and the way it really makes the accounting statement difficult to analyze. So I think this company has a very strange accounting statement, very strange cash flow statement. But this company is guiding to 175 million to 190 million of EBITDA for 2025, and their market cap's only 163 million. Now their enterprise value is large. They do have a lot of debt, but half of their debt is floor plan financing. So dealerships, their inventory is floor plan financing, and that is a pretty low interest rate debt. It's a pretty standard in the industry. It's the other half of their debt that was from the acquisitions that's troublesome and at a higher interest rate. But I think that's sustainable, and their goal this year is just take their free cash flow and try and retire some debt. We'll have to see in 2025 how much debt they can retire. But this company has very, very steadily traded at about 8 times EBITDA for enterprise value. And for every $1 million of debt they pay down, that's $1 million of enterprise value that goes onto market cap. So just for one thing, if they trade at enterprise value of 8 times EBITDA, and their EBITDA goes from a 2024 of 168 million to 190 million or something like that, that's a couple $100 million of market cap. And then you'll probably get another $30 to $50 million of market cap from debt being paid down. So I think this is a pretty solid near term, maybe a 2-year triple. And then on top of that, I don't know if they're going to refinance their debt lower or not when interest rates are lower, but the roll-up's not over. So the roll-up wasn't even their idea. They're one of the distributors for a forklift company named Hyster-Yale. There was also publicly traded. I haven't written about them, but they're probably a double just based on being a value stock that has been totally crushed. So I might have to do a Hyster-Yale write-up. It's much less torque on it than some of the other industrials, but they're also, probably a very reasonable double, especially with the reshoring. We'll go back to Alta Equipment Group. Yeah, I think in 2 years, Alta Equipment Group is going to be a triple, and I'll have to do. I've made a spreadsheet for their discounted cash flow, but I'll record a video on that and put it up on my Substack. A lot of stocks have bounced off the bottom. Not all, but a lot. Put Peabody Energy here. Because again, it crashed all the way to 12, and now it's grinding all the way back up to 14. There's a lot of things that look like that. Now, the question still remains, is this a bull trap? Is this a dead cat bounce? Is this just going to lead to further selling off? And when I look at an individual company and I see its some of the multiples, the market cap for how cheap it is, I just have a hard time thinking that things are going to keep on selling off from here. But I've been surprised in the past. I was really shocked when Medical Properties Trust sold for 25 cents the tangible book. I think, I was shocked when the stock traded below 18 again and it fell all the way to 12. But so my base case is that the worst is over. I could be wrong. I could easily be wrong. But I think the worst is over. I don't know how V-shaped the recovery is going to be. I don't want to make a prediction for a V-shaped recovery, but at the same time, it feels like the market moves faster now. So I talked about how with the S&P 500, this was the 5th fastest correction in modern history, and it did it without even triggering a VIX over 30. So I think the speed of the market, normally when you think of prices moving fast, it's in a chaotic fashion, but this was moving fast and it was orderly. I think the market just moves faster now, which means that when it's also has the capacity to do that on the way up. So normally you say, well, you take the stairs up and the elevator down. That's the cliche. But I think there is a chance of the V-shaped recovery. So there's a lot of people out there saying that V-shaped recoveries are part of zero interest rate policy. I think it's just the speed of the market. I think that when the uncertainty is removed from Trump, now some people are saying that's going to happen before April 2nd, because Trump put this April 2nd deadline. I don't think anybody would really be all that surprised if Trump said there's a new deadline and it's May 1st. I don't think that would surprise anybody. But at the same time, there have been a lot of negotiations ongoing behind the scenes. So yeah, I think it's very possible that when the uncertainty is removed, the market has a pretty healthy bounce. So my vote is that this is not a bull trap. My vote is that the worst is over. But I could be wrong, right? That's risk management is also about having, I'm not increasing my, I'm not increasing leverage here. I'm actually still taking a little bit of cash flow and delevering. because I had a few puts assigned to me on this sell-off. So I'm not taking this as an opportunity to increase leverage, but my best prediction is that I think we recover from here. Anyway, thanks for listening. I hope you guys have a great week. I hope that the worst is behind us, and this is definitely not financial advice.